Welcome to The Explainer. Today we are tracking down a bit of a financial mystery. We're looking at this invisible force that literally governs every single dollar, pound, or euro you're ever going to earn. It's arguably the greatest, yet probably the most profoundly misunderstood, secret in all of investing.
So what is actually the most expensive mistake an investor can make? If you ask around, most people are going to tell you it's buying at the wrong time, right? It's that deep-seated fear of a market crash. It's the anxiety that the very second you invest your hard-earned money, the bottom's just going to fall out. But what if I told you that the data completely contradicts this? What if our biggest financial fears are just entirely misplaced?
Well, to figure this out, we actually need to rewind all the way back to 1930, to this foundational concept established by the economist Irving Fisher. He said, money has a time value, and a pound today is worth more than a pound tomorrow. Now, why is that? It's because the clock is constantly ticking on your money. The cash you're holding in your hand right this second has a superpower that tomorrow's cash simply doesn't have. It can start working for you immediately.
And that brings us straight to the answer of our mystery: compounding. Now, I know it's a word that gets thrown around a lot, but honestly, the mechanics behind it are pretty much magical. Think of it like a giant snowball rolling down a hill. At first, it's small, picking up just a tiny bit of snow, but as it keeps rolling, its surface area expands, and it gathers more and more snow faster and faster. Your money does the exact same thing, but only if you actually give it the runway to roll.
Basically, there are two totally different mathematical paths your money can take. On one hand, you've got simple interest. It grows in a very predictable, straight line. It's calculated only on your original amount, which, hey, makes it great when you're the one borrowing money. But on the other hand, we have compound interest, and this one is exponential. It accelerates because your past interest starts earning its own interest. If you really want to build wealth, this is absolutely the engine you need.
Let's put some real numbers to this, using some fantastic data from Thrivent. Imagine you've got $10,000, growing at a modest 5% for 30 years. With simple interest, you end up with $25,000. Not bad, right? But with compound interest, you finish with over $43,000. That is an extra $18,219 generated completely out of thin air, simply by letting your earnings earn. Time is definitely compound interest's secret weapon.
Okay, so we know time is the weapon, but human nature kind of gets in the way, doesn't it? We get anxious, we want things to settle down, and we hold out for that perfect moment. But what is the actual, measurable cost of that hesitation?
Well, it's definitely not just some theoretical loss. According to analysis on a framework with a historical 23.4% compound annual growth rate, just a single month of delay on a 100,000-pound portfolio costs exactly 1,917 pounds. Just one single month of waiting.
But watch how incredibly fast this snowball works against you when you just sit in cash. A mere 6-month hesitation rapidly snowballs into a massive 5-figure hit. We're talking 11,942 pounds of foregone compounding, just gone. So here is the absolutely crucial point. A 12-month delay cost 23,400 pounds. And look, these aren't losses in the sense that someone hacked your bank account. They are unrecoverable returns. You can literally never get them back because compounding is a one-way clock. Every single day you sit in cash, you are paying an invisible price.
Right, so if waiting costs tens of thousands, then surely the smartest move is to just wait for the absolute perfect time to buy, right? Buy at the very bottom of the market crash. Well, to tackle that specific anxiety, let's look at a pretty fascinating 20-year study by the Schwab Center for Financial Research.
They tracked a few hypothetical investors over 2 whole decades, each putting $2,000 a year into the market. First up, Tanya. Tanya had a literal crystal ball. She always bought at the exact market bottom. Then there's Ashley. She just invested immediately every year, no timing at all. Then we have Bad Bart. Poor Bart had hilariously terrible luck. He always bought at the absolute peak, right before a crash. And finally, procrastinating Peter, who just stayed in cash waiting for that perfect, safe moment that, well, never came. So, who won and who lost?
Well, Tanya won, naturally, but Ashley was incredibly close behind her. Here's the mind-blowing part, though. Look at Bad Bart. Bart bought at the worst possible times for 20 straight years, yet he decisively beat procrastinating Peter, who waited safely in cash. Being invested in a compounding asset, even at terrible prices, completely and totally outperformed being uninvested.
In fact, Tanya's absolutely perfect timing, across 20 years,
It gave her a barely noticeable 0.4% annual advantage over Ashley, who just dumped her money in immediately. The gap between immediate investment and waiting in cash was way, way larger than the entire advantage of having a crystal ball. And this advantage amplifies exponentially over a lifetime. Let's look at how age factors in. This data from HCR Wealth Advisors compares investor A, who starts at age 25, invests for just 10 years, putting in 50 grand total, and then just stops completely. Now compare them to investor B, who starts 10 years later at age 35 and invests every single year until age 65, putting in a total of $150,000. Because investor A gave that compounding snowball more time to roll early on, they will actually crush investor B's final returns. And that is despite investing just a third of the capital. Crazy, right?
So clearly, time is everything. But let's be honest, it can be really hard to visualize exponential math in our heads. So, is there a practical, empowering tool we can use right now to kind of demystify our own financial futures without needing some massive spreadsheet? Actually, yes, there is.
It's called the Rule of 72, and it is a stunningly simple little mathematical shortcut. All you have to do is take the number 72 and divide it by your expected annual rate of return. The resulting number is exactly how many years it will take for your money to double.
Just look at how this plays out in real life. If you're getting, say, a 4% return, 72 divided by 4 means your money doubles every 18 years. But what if you optimize your investments and find a 9% return? Well, 72 divided by 9 means you double your money every 8 years. Just finding slightly better returns dramatically compresses the time it takes to build real wealth.
Okay, now we know how long it takes to double, but how do we actually feed this compounding machine? How do we make absolutely sure that snowball gets as massive as geometrically possible over our lifetime? Well, there's one final piece of the puzzle we haven't talked about yet.
That catalyst is the continuous loop of dividend reinvestment, often called a DRIP plan. See, when you own certain stocks or funds, they literally pay you a portion of their profits in cash. Those are your dividends. But instead of taking that cash and spending it, a DRIP automatically uses those exact cash payouts to buy more fractional shares of that exact same asset.
It creates this relentless, fully automated growth cycle. Think about it. You earn dividends, you automatically buy more shares. And because you now own more shares, you earn even larger dividends the next time around, which buys even more shares. It completely forces your money to snowball. It smooths out market volatility through dollar-cost averaging. And best of all, it requires absolutely zero manual effort from you. It really is the ultimate passive wealth-building strategy. Which really brings us to the ultimate takeaway from all the historical data, the Schwab studies, the Wharton School research, and just the undeniable mathematics of money we've explored today. The question is never whether to invest. The market's long-term upward trajectory is clear as day. The only real question is whether you are going to start today or if you are willing to pay the massive, invisible compounding cost of waiting for tomorrow.
Because if there is one unchangeable truth we've uncovered in this explainer, it's this. The compounding clock is running continuously. It doesn't wait for you to feel ready. It absolutely does not care about market peaks or valleys. It only cares about time. So, the clock is ticking. What will you do today?